Financial trend identification relies on methods such as moving averages, trend lines, and momentum indicators like the MACD and RSI. Visualization techniques include overlaying trend lines on candlestick charts and using color-coded time series graphs to highlight upward or downward trends. Effective trend analysis has been shown to improve trading success rates by helping traders anticipate future price movements based on historical patterns and volume data. Common charts in technical analysis include line charts, bar charts, candlestick charts, and point and figure charts. Candlestick charts are widely preferred for their detailed depiction of price action within periods, showing open, high, low, and close prices. Chart selection often depends on the investor's time frame and trading strategy, with over 70% of analysts reporting candlestick charts deliver better insights on market sentiment. Best practices include selecting appropriate time frames, ensuring data accuracy, using consistent scaling, and applying indicators suited to the market context. Interpretation requires cross-verifying signals with volume and trend strength to avoid false positives. Studies suggest that combining multiple indicators improves forecasting reliability by up to 25%. Additionally, charts should be kept uncluttered to maintain readability. Scenario analysis involves assessing potential outcomes by simulating various economic conditions and their impacts on asset prices and portfolios. In financial markets, this tool helps in stress testing and forecasting under conditions such as interest rate shifts, economic recessions, or credit events. Institutions employing scenario analysis report enhanced risk identification and adaptive strategy formulation, critical for navigating volatile markets. Debt market analytics focus on yield curve analysis, credit spreads, duration, and convexity metrics to assess bond valuation and risk. Advanced techniques include using regression models to predict spread changes and Monte Carlo simulations for price volatility. These approaches enable investors to manage interest rate risks and credit exposure, vital in markets where bond prices are sensitive to macroeconomic shifts. Scenario analysis is key for risk management by allowing firms to anticipate potential losses under various adverse conditions and ensure capital adequacy. It supports regulatory compliance with frameworks such as Basel III, which requires stress testing of loan portfolios and market risks. Scenario outputs feed into risk-adjusted performance metrics, enhancing decision-making and early warning systems for financial institutions. Market indices aggregate performance of selected securities to represent sectors or entire markets, using weighted averages such as price-weighted or market cap-weighted. Interpretation involves comparing index trends with economic indicators to gauge market sentiment. For example, the S&P 500 is a leading benchmark reflecting U.S. equity health, with historical data linking index movements closely to GDP growth rates. Risk estimation employs metrics such as value at risk, VaR, conditional VaR, volatility measures, and scenario analysis. Statistical tools like Monte Carlo simulations and historical simulations quantify potential losses at given confidence levels. These methods are critical for portfolio managers to balance return expectations against probable downside, informing risk limits and hedging strategies. Indices serve as benchmarks to evaluate portfolio performance and to construct index tracking funds. Portfolio managers use indices to assess diversification benefits, calculate tracking errors, and optimize asset allocation using techniques like the Sharpe ratio. Studies indicate portfolios aligned with indices often achieve lower volatility and competitive returns, highlighting index utility in risk-adjusted performance analysis. Market shocks manifest as sudden, significant price changes often triggered by geopolitical events or economic surprises. Visualization tools such as high-frequency time series plots and heat maps help detect these abrupt changes. Empirical research suggests early shock detection improves risk mitigation by enabling rapid portfolio rebalancing. Jump effects refer to sudden price discontinuities within seemingly continuous market movements, often reflecting new information absorption. These impacts increase price volatility and can distort traditional risk models. Quantitative jump detection uses statistical methods such as by-power variation, improving volatility forecasting and option pricing accuracy. The butterfly effect in finance describes how minor initial changes can lead to disproportionately large market outcomes through nonlinear processes. This concept is foundational in chaos theory applications, illustrating market sensitivity and unpredictability. Understanding these effects aids in managing systemic risks and developing robust trading algorithms. Trend visualizations in simulations often use synthetic price series generated by models such as geometric Brownian motion. These visualizations help identify potential uptrends, downtrends, or sideways markets and validate trading strategies under controlled scenarios. Incorporating volume and volatility overlays enhances the realism and interpretability of simulated data. Simulations utilize jump diffusion models and threshold-based detection algorithms to replicate and identify sudden price discontinuities and shocks. These methods improve the robustness of risk management simulations by adding unpredictable events, reflecting real market complexities. Analytical outputs guide traders in recognizing shock signatures and adjusting hedging tactics. Interpreting simulation results involves assessing scenario outcomes against expected theoretical behaviors, identifying model limitations, and refining parameters. Practical insights include recognizing patterns that precede volatility spikes or trend reversals, enabling better strategy calibration. Simulation outcomes serve as risk-free environments for testing hypotheses before live market application. In summary, this unit has equipped us with advanced techniques for visualizing trends, performing scenario analysis, and estimating risks in financial markets. We have explored how to detect market shocks and understand their impacts through various analytical tools and simulations. These insights empower better decision-making and risk management in dynamic market environments.